Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we really get into the weeds today, just a quick reminder about StockOracle. We've got a special 14-day trial link right below in the description.
Yeah, exactly. And just to be clear, StockOracle is an AI-aided stock research platform. It is not financial advice, it's not a trading signal service, and it doesn't give real-time market data.
Right, and that link down there is an affiliate link, so the channel may earn a commission if you use it, but that's at absolutely no extra cost to you.
Which we definitely appreciate.
Yeah.
But, as always, keep in mind that StockOracle's AI insights and their valuation estimates, they can be incomplete or just flat out wrong. So always verify the important facts yourself.
Absolutely. Do your own homework, guys.
Okay, so I want you to picture a company that managed to grow its revenue by nearly 490% in a single year.
Which is just a wild number.
Right. A company that somehow negotiated this staggering $27 billion deal with Meta. Yeah. But, and here's the massive catch, this same company carries a price-to-earnings ratio of over 1,500.
Oh, wow. Yeah, 1,500.
Like, for context, a mature tech giant usually trades at a PE ratio around, 30.
Yeah, 30 is pretty standard.
And even a hyper-growth software stock might push, like, 80 or 90. But 1,500 sounds like a broken algorithm. It doesn't even sound real.
It really doesn't. And, seeing numbers like that, it usually forces your brain to categorize the company into one of two extremes, right?
Right.
Like, either you are looking at the foundational monopoly of some brand new technological era, or you're staring at a spectacular financial bubble that is stretched so thin it's, like, almost translucent.
Exactly. And the binary nature of that setup is exactly what we are exploring today with Nebius Group. Because they operate in the AI, cloud, and GPU infrastructure space. Which puts them at the very absolute center of this current artificial intelligence build-out.
Yeah, they are right in the middle of it.
So we need to unpack that historic top-line revenue growth, the massive physical capital requirements needed to actually sustain it, and how Wall Street is attempting to price an asset that just seems honestly entirely disconnected from traditional gravity.
Which, honestly, requires a fundamental shift in how we even think about tech companies right now.
How so?
Well, we've spent the last, 2 decades conditioned by the software as a service model.
Oh, yeah. So it's everything.
Exactly. Where growth is just a matter of adding more server space and bumping up the marketing budget.
Right.
But Nebius is not a software story. It's a story about pouring actual concrete, laying miles of high-voltage cables, securing industrial cooling systems, and buying physical silicon.
It's heavy industry.
Exactly. It's heavy industry wearing a tech trench coat.
So let's start with the scale of the revenue growth. Because, that is the engine driving the market's total obsession here.
Oh, definitely.
The historical revenue ramp is almost unbelievable. In 2023, Nebius reported a very modest $9.8 million in revenue.
Which is tiny in this space.
Right. But by 2024, that jumped to $91.5 million. And then for 2025, it rocketed to $529.8 million.
And the momentum actually continues to build on top of that.
Yeah.
Yeah, if you look at just the second quarter of 2026, they reported $582 million.
Wait, in just one quarter?
Just one quarter. That means in a single 3-month period, they beat their entire previous year's revenue.
That is insane.
It's a 454% year-over-year growth rate for the quarter.
Wow.
And looking ahead, their guidance suggests they'll pull in between $3 billion and $3.4 billion for the full year of 2026.
Okay, when you see a jump from $9.8 million to over $3 billion in roughly 3 years, the immediate question is, how?
Yeah.
Like, what is the catalyst pulling that much cash through the door so quickly?
Well, the anchor for all of this is that $27 billion compute deal with Meta.
Right.
But to understand why Meta would commit $27 billion to a relatively small player in 2024, you have to kind of zoom out and look at the broader supply chain.
Okay, lay it out for me.
So GPU compute capacity, specifically the hardware needed to train these massive AI models, it's essentially the new global oil.
Oh, totally.
And the major legacy cloud providers were either totally booked solid or they were busy developing their own competing models.
Right. So Meta couldn't just go to the usual suspect.
Exactly. Meta desperately needed guaranteed dedicated capacity, and Nebius stepped up with an astonishing $40 billion total backlog.
40 billion.
Yeah, and an ambitious target to build out 5 gigawatts of power capacity.
Okay, I need us to pause on that 5 gigawatt number.
Yeah.
Because it's really easy to just say gigawatt and move on to the next stat.
It really is.
But 5 gigawatts is not just, plugging some extra servers into a wall socket.
Not at all.
That is roughly the power consumption of multiple major cities combined.
Yeah, it's massive.
Securing that means you are negotiating directly with regional power grids, you're building dedicated substations, navigating all these local zoning laws for massive industrial facilities.
Which introduces just immense friction. Like the bottleneck for artificial intelligence is no longer just how fast you can design the chips.
Right.
It's literally finding a physical place to put them where the local power grid won't just instantly collapse when you flip the switch.
Right. So, okay, they are making money hand over fist on paper. And the gross margins look incredible. Looking at the numbers, they have a trailing 12-month gross margin of over 74%.
Which sounds amazing.
It sounds perfect.
Yeah.
But when you look at their actual net income, that margin just vanishes. The net margin is barely over 3%.
Yeah.
So where is the friction happening between that 74% gross margin and the actual bottom line?
Well, the friction is the physical reality of what they're actually building.
Okay.
That 74%, that reflects the markup on renting out the compute power. But running these facilities requires a massive, ongoing operational burden.
Like the electricity.
Exactly.
Yeah.
You have huge electricity costs, specialized maintenance crews, crazy cooling systems. But more importantly, though, you have the brutal reality of hardware depreciation.
Okay, let's unpack this with an analogy because I think it helps. It sounds a lot like opening an ultra-luxury rental car company.
Okay, I like where this is going.
Right, so you have to buy fleets of Ferraris up front.
Yeah.
For the first year, everyone wants to rent them, and your gross margins look totally amazing.
Sure.
But 3 years later, newer, much faster models hit the market. No one wants your old cars, and your initial assets are suddenly worth a fraction of what you paid.
That captures the dynamic perfectly. With the added caveat that AI chips age out even faster than luxury cars.
Oh, man.
Yeah, as new generations of chips are developed by the manufacturers, the older hardware becomes dangerously obsolete for training cutting-edge models.
So they can't even use them.
Right. So Nebius constantly has to write down the value of their existing hardware while simultaneously buying the absolute newest chips at a premium.
Right. Right.
Which is why, despite swinging from a massive net loss in 2024 to a net income of $82.5 million in 2025, their Q2 2026 earnings report still showed a loss of 12 cents per share.
Because the heavy ongoing investment just physically drags down their net profitability.
Exactly.
Which means that razor-thin 3% net margin is kind of the perfect bridge into the dark side of this AI infrastructure boom.
Oh, it gets dark.
Yeah, the capital expenditures, like the actual cash required to buy the land, build the centers, and purchase the chips, are terrifying.
They really are. The free cash flow proxy paints a very stark picture here.
Explain the proxy really quick for everyone listening.
Sure. So to clarify, the free cash flow proxy is just a rough estimate of the actual cash entering or leaving their bank account after they pay for all their operational costs and all that new equipment.
Got it.
So for fiscal year 2025, that number sits at a negative $3.68 billion.
Negative $3.68 billion.
Yeah.
Because their capital expenditures are just exploding right alongside the revenue.
Yes.
Like CapEx was just $82.9 million in 2023. Then it jumped to $807.5 million in 2024. And in 2025, over $4 billion.
And even more concerning is the forward-looking requirement. Current estimates suggest Nebius requires another $20 billion to $25 billion in future capital expenditures just to hit their targets and actually fulfill that massive backlog.
Wait, okay, I need to push back on the math here.
Okay, go for it.
The numbers say they currently have about $3.6 billion in cash and cash equivalents on hand.
Right.
But they need up to $25 billion to build out these data centers. At the same time, their total liabilities have already ballooned from roughly $295 million in 2024 to $7.8 billion in 2025.
Yeah, it's a huge jump.
And their total debt is reaching $10.2 billion by Q2 2026. So how do they bridge a $25 billion gap without massively diluting the shareholders by just, issuing millions of new shares?
Well, they're utilizing a very clever yet highly precarious financing strategy.
Yeah.
They are essentially relying on their clients to act as their bank.
Oh.
Yeah, the information indicates Nebius is covering 50 to 60% of their capex through customer prepayments.
Ah, I see. So companies like Meta are handing over billions of dollars in cash up front to build the specific servers they eventually plan to use.
Exactly.
It's like a defensive move by the client.
Yeah.
Meta is essentially saying, we need this compute power so badly, we will fund the construction of the building ourselves just to guarantee we have the keys when it's done.
That is exactly it. And that prepayment structure is totally vital, but it still leaves a multi-billion-dollar shortfall.
Right.
So to cover the rest, Nebius is utilizing a $775 million asset-backed facility.
Okay. Meaning what?
In simple terms, they are borrowing against the physical value of the hardware they are actively installing.
Oh, wow.
Yeah, it's like taking out a mortgage on the data center itself.
But taking out a mortgage on hardware that depreciates as fast as we just discussed with the Ferrari analogy, that introduces an immense amount of leverage risk.
Huge risk.
Like what happens if the current fever pitch for AI cools down and cloud computing pricing suddenly just drops?
Well, that scenario exposes the Achilles heel of their entire financial model.
Right.
Right now, AI cloud pricing is at an absolute premium because the demand vastly outstrips the supply.
Of course.
But if chip supply catches up or, if tech companies realize they don't actually need as much compute power as they initially projected, those leasing prices will compress.
And suddenly, that razor-thin 3% net margin flips negative.
Exactly. But the interest payments on $10.2 billion of debt, those remain exactly the same.
The debt does not care what your margins are.
The debt never cares.
So with hypergrowth on one side and a literal mountain of highly leveraged debt on the other, you have to wonder how Wall Street is attempting to price this kind of setup.
Yeah, and the technical indicators show a market completely torn between momentum and exhaustion.
Okay.
Like, from a pure trend perspective, the stock looks totally unstoppable. It's up over 242% over a 52-week period.
Unbelievable.
Yeah, and it's trading comfortably above its 20, 50, and 200-day moving averages, which traditionally signals really strong, sustained buying pressure.
But the human psychology behind those charts tells a bit of a different story, doesn't it?
It does, specifically when you look at the Relative Strength Index, or the RSI.
Right.
The RSI sits at 70. Now, in technical analysis, an RSI of 70 pushes right into overbought territory. But an RSI of 70 isn't just a mathematical number, It's a reflection of human FOMO, that fear of missing out.
Oh, for sure.
It means buyers have been aggressively chasing the stock upward without really taking a breath. And historically, when a stock stretches that far, the last buyers jumping in are often standing on a trapdoor.
And we actually saw a hint of that trapdoor opening recently, didn't we?
We did.
Right after that stellar Q2 earnings beat, the one reporting 454% growth, the stock actually dropped 7.6%.
Yeah.
It was like a classic sell the news reaction.
Which really reveals how much perfection was already baked into the share price before the earnings were even announced.
Right, because everyone already expected a miracle.
Exactly. When a company trades at roughly 47 times its sales, meaning investors are paying $47 for every $1 the company makes in gross revenue.
Which is wild.
Yeah, there is zero room for error. The market isn't just expecting growth, it is demanding flawless, uninterrupted execution. And this kind of explains why D.A. Davidson analyst Gil Luria raised his price target on Nebius to $250, but crucially maintained a neutral rating.
Meaning he thinks the stock is basically fairly valued right where it sits today. Like, even with all that historic growth, the risk and the reward are just perfectly balanced on a nice edge.
Yeah, it implies the phenomenal growth is fully priced in, but the debt risk caps the upside.
Here's where it gets really interesting, though.
Oh, yeah.
Yeah, if you want to know what the people inside the building actually think about that 1,500 PE valuation, you just look at their behavior.
The insider trading.
Exactly. The information shows that insiders at Nebius have executed 37 sales recently. And how many open market purchases? Exactly 0.
Well, to play devil's advocate, insiders sell shares for all sorts of benign reasons, right?
Yes, sure.
Like tax obligations, buying real estate, or just simple portfolio diversification.
Sure, I get that.
Sure.
But 37 sales and 0 buys paints a very specific picture of human behavior.
Yeah, it's hard to ignore.
When the executives closest to the $25 billion capex problem are taking chips off the table, and absolutely none of them are buying back in at these prices, you really have to pay attention.
You do. And those insider moves contribute to a deeply polarized sentiment across the broader market right now.
It's so split.
It really is. You have fundamental growth catalysts like the massive backlog, the Meta deal, the earnings beats, and they are screaming bullish.
Right.
But the bearish counterweights are getting louder by the day. You have analysts explicitly warning of a bull trap.
Okay, explain the bull trap for us.
So a bull trap occurs when a stock looks like it's breaking out to new sustainable highs, which tricks retail investors into buying in.
Oh, no.
Yeah, only to immediately reverse and plummet, trapping those buyers in really heavy losses. And they cite these incredibly expensive expectations as the trigger for that.
Man, and there is also a fascinating, albeit, unconfirmed rumor floating around the market regarding Michael Burry.
Oh, yes, the big short himself.
Right. So there's this highly speculative report that Michael Burry, the investor famous for his massive short position during the 2008 housing crisis, has taken a short position against Nebius.
Now, we must emphasize for you listening that this is entirely speculative.
Completely.
It has not been independently confirmed by an SEC filing in any of the materials we're looking at.
Right.
However, the mere fact that the rumor exists and is actually gaining traction in trading circles tells you exactly how vulnerable the market perceives this current valuation to be.
Exactly. So given this incredibly polarized tug of war, we really need to outline the specific dominoes that need to fall here, like what will either derail this thesis completely or send the stock into a new stratosphere. Let's break down the balancing act.
Okay, let's start with what is already priced into the stock. That 242% return over the last year absorbs an immense amount of good news.
Yeah, it does.
The $27 billion Meta deal, priced in. The massive Q2 earnings beat, priced in. Even the lofty $3 billion to $3.4 billion revenue guidance for 2026 is already anticipated by the current share price.
So simply hitting those targets won't move the needle upward. The upside surprises have to be structural at this point.
Precisely. Which is why Nebius needs to prove they can hit their specific EBITDA margin target of around 40%.
Okay, EBITDA?
Yeah, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically the cash profit they make purely from running the data centers before Wall Street, the IRS, and hardware depreciation take their cuts.
Right before reality sets in.
Exactly. Hitting 40% would demonstrate real operating leverage. It would prove that as they scale, they actually become significantly more profitable.
Okay.
They also need to prove that customer prepayments can cover an even larger share of that $25 billion capex pipeline to reduce their reliance on that risky asset-backed debt.
Okay, so that's the upside. But what are the blind spots? Like, what are the specific risks that are not currently priced in and could trigger a really sharp downside?
Well, the largest blind spot is the harsh reality of securing that $25 billion. If they face a single financing hiccup, or if they are forced into a massively dilutive equity raise.
Meaning they suddenly flood the open market with millions of new shares to raise emergency cash.
Exactly. If they do that, the stock value will instantly dilute and suffer. And we also have the looming threat of margin compression if the overall hype for AI cloud computing normalizes and leasing prices fall.
And if you take that a step further, you hit the severe customer concentration risk.
Right.
Because the $27 billion Meta deal is so large, a massive portion of their future relies entirely on Meta remaining happy, solvent, and committed to this specific hardware architecture.
Yeah. If anything sours in that single corporate relationship, or if Meta just decides to pivot its AI strategy completely, the ripple effects would be catastrophic for the Nebius balance sheet. So what does this all mean for you, the long-term observer? How do you interpret these signals without getting swept up in the AI hype cycle? We have unprecedented growth, a massive moat built on sheer power capacity, but a balance sheet that is highly leveraged and dependent on client prepayments.
Yeah, and this really raises an essential question about execution versus expectation. Our overall assessment, based purely on the numbers, lands at a neutral stance. It equates to a 5 out of 10 rating.
A 5 out of 10.
Right. The growth story is undeniable. It's perhaps one of the most explosive revenue trajectories in the entire equity market today. But the risk-reward ratio at current price levels appears incredibly stretched.
Definitely.
Navigating this requires monitoring their quarterly revenue ramp against that $3 billion guidance, scrutinizing how they source their ongoing CapEx financing, and keeping a very close eye on their leverage trajectory over the next 6 to 18 months.
Yep.
And just to be absolutely clear again, this is an objective observation of the data, not financial advice to buy, sell, or hold the stock. Right. So Nebius Group really represents the ultimate stress test for the entire AI infrastructure build-out. It's a company locked in a fierce, high-stakes battle against its own rapidly expanding leverage, carrying a valuation that demands perfection and leaves absolutely zero room for human error, supply chain disruptions, or macroeconomic shifts.
Yeah, they are attempting to build the infrastructure of the future, but they are forced to pay for it using the traditional financial tools of the present.
Wow.
And those tools have hard, unforgiving limits.
Which leaves us with a final thought to mull over as we watch this incredible space evolve. We spend so much time marveling at the sophistication of the new AI software models, right? The neural networks, the algorithms that seem almost magical.
Sure.
But as we look to the future of technology, is the true bottleneck for artificial intelligence no longer the intelligence of the software itself, but the raw, brute force ability of the global financial system to actually fund the physical concrete, copper, and electricity required to keep the lights on?
Yeah, it really makes you wonder. The physical realities of the power grid and the bond markets might actually end up being the ultimate governors on the pace of human innovation.
Exactly. The next time you are amazed by a new artificial intelligence tool, generating a video, or writing a complex code base, just remember the immense, grinding physical machinery operating behind the curtain. Somewhere, a company is moving mountains of debt, securing gigawatts of power, and racing against depreciation just to process your prompt. That is the reality of Nebius Group, and it is the reality of the AI revolution.
It really is. And on that note, just a final reminder that Nebius sits at a neutral 5 out of 10 on our investment rating for now, really depending on if they can manage that massive CapEx mountain. We're keeping a cautious long-term view.
For sure. And if you enjoyed today's analysis, don't forget to subscribe, like, and drop a comment below. And definitely check out the link in the description for your 14-day trial of StockOracle to explore these kinds of AI-aided insights yourself. Thanks for joining us, and we'll see you next time.